What's up, everyone? All right, so in this episode, we're going to speculate what is the Federal Reserve going to do tomorrow when we find out about the interest rates, and I want to hear what you guys think is going to happen. So we have three options. Number one is they say they're going to pause. No interest rate hikes. We're going to defer it. We're going to push back because of what happened in Silicon Valley Bank and these other banks. We're just going to pause. Second option is they're going to go with a quarter basis point hike, which is what they had sort of initially suggested they were going to do. And then the third is they're going to go with a half basis point hike, which they had kind of given themselves maybe the runway that they might do that. So those are the three options. What do you think they're going to do? No hike, pause, and maybe they don't call it pause, but they just no hike right now, quarter basis point or half a basis point. So obviously we had the inflation, the CPI numbers for the last month that just came out. And they were still hot. Obviously we're still in a high inflationary environment. I think it was 6.4%, but I didn't look closely at it. So I knew it was still high. It came in around expectation, but it's not decreasing. And this is, year over year measurement. So we're still high in inflation. Okay, but we've just had this collapse in Silicon Valley Bank. And then we've also had the First Republic Bank bailout, so to speak, the 11 big banks infusing cash infusion of, 30 billion. And then we've got what's going on with Credit Suisse. So the fact is right now, it feels like we're in this environment where in 2020, the Federal Reserve, basically used everything it could to stimulate the economy. And man, the economy went hot, super, super hot. 2020, 2021. And then 2022, they're like, wow, inflation's not transitory. Now we need to put on the brakes. But the economy is like this massive ocean liner. It doesn't turn on a dime. It doesn't stop. And so there's that expression that monetary policy is lagging. So anything that they do today, it's going to take maybe 6 months, maybe longer, to really see the true effect. So does that mean right now, when we're seeing some of these banks collapsing, this is the effect of a decision that was made 6 months ago? And so what is it going to look like 6 months from now? So that makes me think that if it were me, I would say, wait a second. Of course, it's not me, but if it were me, I would be saying, wait, we wanted to slow down the economy. We wanted to increase interest rates, so maybe people wouldn't be buying houses as quickly. That would reduce the housing prices, right? That would soften the housing market a little bit, make it more affordable. Maybe we want to slow down the car market, slow this stuff down. Naturally, that could result in some layoffs in some of those industries. Realtors aren't selling as many houses, some layoffs. Car dealers aren't selling as many cars, slow down there. And that all would be kind of a nice gradual slow landing. And then we just had a bank collapse. So I feel like that was unintended. I can't imagine that they would have been like, we're going to try to knock down some banks here. No way. That was definitely, I'm sure, unintended. And actually what it does is it highlights that Silicon Valley Bank, because of this, and I mentioned this in another episode about why the banks are collapsing, the HTM accounting rules of held to maturity, the ability on a balance sheet to show the value of an asset they bought based on its value at maturity, which could be 20 years out, and to not have to write on the balance sheet show the face value, which in the case of bonds last year, both stocks and bonds went down. So we found out that Silicon Valley on their 10K from just last month was showing $91 billion in assets that were held to maturity. So their true value, their face value, if forced to sell them, a lot lower. So it kind of seems like, this increase in interest rates over the last year, which has been historic, is now sort of, it's like squeezing, some little surprises out. And all of a sudden we're like, whoa, we've got this held to maturity accounting issue in the banking sector. Right? So maybe regulators didn't do enough on Silicon Valley Bank or in the way to change this accounting rule. And there were some changes to it, but they didn't fully address it in the last 5 years or so. So I would say my hope is that they say, let's just pause. What they might say is we're going to proceed with a quarter basis point hike because these are atypical situations with these banks that are in trouble right now, and the market, the government is more than capable of bailing them out and unwinding it. We've dealt with bigger issues than this, so this isn't going to be a problem, and it's isolated. So the economy is strong, the banking system is strong, the economy is still hot, we need to cool it down. We're just going to see the course and not make any changes. And maybe, in fact, that would be a bigger vote of confidence. But it's hard to feel confident, when the whole transitory thing was so wrong. So what do you guys think? I don't know. Let me know down below in the comments. I think it's certainly going to have an impact on the market, no doubt about it. And for small cap traders, we continue to be in this bank drama that's taking a lot of attention away from the small cap market that we're typically trading in. So this has been a very difficult time for any of us to really probably find any edge whatsoever. So this is a time where, as far as I'm concerned, I'm just kind of laying low, holding tight. I've taken a couple losses and I'm just like, you know what? Just stepping back. No reason to dig a big hole right now. Let's just see how things unfold over the next week or so. So there will, I'm sure, be some really great opportunities ahead, but right now it's very choppy. So I'm curious to hear what you guys think is going to happen. Is the Federal Reserve going to increase interest rates this week? Let's find out.